At the end of the trading weekend, amid the empty economic calendar, Friday could have been fairly quiet in the markets, but the lack of economic news today was more than compensated for by political news from the Middle East. After the media reported an Israeli attack on Iranian military facilities, currencies and stocks rushed to one extreme. But then it became clear that both sides apparently did not want to escalate this conflict. This again triggered a wave of volatility across financial markets, but now in the opposite direction. For example, the US dollar, along with the Japanese yen and the Swiss franc, immediately began to grow as a safe haven currencies after the first alarming messages. And since the news we received from the Middle East region is not entirely clear, the situation in the markets will remain unstable. We can track this instability on the chart of the world's main currency. The US dollar index, which determines its value against 6 rival currencies, is trading within the intraday corridor between 105.90 and 106.40. At the same time, the price gradually shifted from the upper border to the lower one. The greenback weakened in response to the revision of monetary prospects in other countries, although it initially seemed that many central banks would cut rates before the Fed Reserve. High inflation may well interfere with these plans, for example, in England or New Zealand. As for the US Central Bank, yesterday the rhetoric of some of its representatives was also hawkish. For example, President of the Atlanta Federal Reserve Bank, Raphael Bostic, doesn't think that monetary easing until the end of 2024 would be appropriate. The policymaker said that the decline in inflation towards the target of 2% will be slower than expected. Besides, he is uncomfortable cutting interest rates in a mad rush because demand for the workforce is high and wage growth remains strong. Neil Kashkari from the Minneapolis Fed is on the same page. He believes that the Fed Reserve could potentially keep interest rates at the current level throughout the year. US financial policymakers make such bold statements for obvious reasons, of course. After all, over the past few weeks, the US dollar owes its strength to a strong American economy. On the other hand, recent economic data, especially hotter than expected annual CPI at 3.5% in March, forced traders to reconsider the number of rate cuts in the United States, and now most market participants expect the first rate cut only in September. By the way, the revised forecast caused a sharp jump in the growth of US Treasury yields. As a result, the dollar index showed its highest levels in the past 5 months at the beginning of this week. Its main counterparts in the basket of currencies, the euro and the pound sterling, plunged this month by 1.3% and 1.5% respectively. The robust economy and the hawkish Fed's rhetoric point to the status quo in the Fed's monetary policy in the near future. Meanwhile, Wall Street is whining just released corporate reports, and this reaction cannot be called positive. In addition, after the first news on Israeli strikes on Iran, the world literally froze in anticipation of the worst. This fear provoked additional capital outflow from risky stocks. After 5 losing sessions in a row, the S&P500 is preparing to close Friday and the entire week also in the red. Today, the index is trading lower within an intraday corridor between 5,001 points and 5,057 points. During the Asian session, the market was clearly in favor. Later on, major currencies recovered to their initial market quotes. Traders tried to come to their senses. If we talk especially about the euro-dollar pair, then its pullback ended as quickly as it began. On the back of the US dollar's recovery, the euro returned to the support level of 1.06. Then the improvement in risk sentiment in turn put pressure on the greenback and pushed the euro rate a little higher on the eve of the weekend. On a Friday, the euro-dollar pair is trading in an intraday carried between the yen-to-date low of 1.0601 and resistance of 1.0700. Moreover, the level of 1.06 can act as both support and resistance. In the second case, the single currency may reach a local low of 2023. Everything related to the forex market is fully applicable to the energy market. The news from the hotspot triggered a sell-off in risky stocks, a rally in the US treasuries and safe haven currencies, and also caused a surge in oil and the gold prices. The only difference is that the scale of oil price fluctuations is greater than that of other assets. This is not surprising because Iran is the main oil producing region of the world. As a result of a speculation, prices for petroleum products jumped even by 4.5%. So, after such a shake-up, crude oil is also still trying to recover. Emotions must ebb away before investors can calmly decide on the further direction of oil prices. During the American session on Friday, the benchmark Brent is trading quieter, consolidating at the upper border of an intraday carried between 86.20 and $87.30 per barrel. Gold also rose as the safe haven metal benefited from ongoing turmoil in the Middle East and the prospect of a smaller than expected Fed's rate cuts this year. Spot gold added 0.8% and appeared to be rallied towards $2,400 per ounce. You have watched the market review by InstaForex analyst for Friday, April 19. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments. I'll see you online next week.